So I spent a long time thinking about what is going on and seeing the markets go up so fast in the middle of still what the largest recession of our lifetimes and basically of the last 100 years. And I realized that if you divided the S&P or any of these by the Fed balance sheet, they'd gone nowhere. So they were just offsetting the debasement. So I started looking through all markets, thinking, okay, what's offsetting and what's not? And what's interesting is the S&P was basically just about offsetting it. Gold was doing okay, but not great. Real estate was about the same. They were all kind of trading in a range with each other, which showed you this denominator effect that I'm talking about was happening, except two things, the NASDAQ and crypto. Let's forget crypto, the NASDAQ. Why? And the classic Twitter refrain is old man shouting at the internet, it's a bubble. But when you look at it, this technology that is going on is facing network effects, Metcalfe's law. These are not like bringing out a new product, a better mouse or whatever, right? These are things, new things that create adoption effects. Adoption effects, network effects, Metcalfe's law don't price in P/E ratio terms. That's why nobody owned Amazon all the way up, particularly cynical people, macro people, gold bugs. It's like, I can't own this. It's
right.
and
why Tesla at its valuation was still rising.
Correct. And nobody got it, and they still don't get it. But those FANG stocks have outperformed, and we all got it wrong. To be honest, we all got it wrong. And because we didn't understand. But the more we got into crypto, the more we started to understand network effects and realizing that it applies. Okay, so what is coming down the pike is something so extraordinary that I've just changed my entire macro framework based on it.
Wow.
Is thinking about this, thinking about, okay, what is the true denominator, and realizing, okay, technology is outperforming crypto. And then you start thinking, right, we've just developed a mRNA, I can't even pronounce it ever, the vaccine that has come in basically in 2 months. Groundbreaking, 20 years of work, but they basically cleared it through. Now that may clear malaria and a whole bunch of others. People are working on cancer stuff using the same technology. Biotech is going to have money thrown at it. That's one. The other one is I was writing a piece about carbon offsets in Europe, which is a fantastic trade. And writing that piece, I realized that the EU is basically going to reduce all its carbon emissions 65% in the next 9 years, right? And it's going to drive a massive green revolution. And it's happening everywhere. It's not just the EU. And before it used to be, it's 20 years ahead. It's now happening. Every car outside my window here in the Cayman Islands, in 10 years' time, it's going to be obsolete.
Sure.
So think of the number of cars that have to be sold. Electric cars. Think of the technology that goes with electric cars. Things like edge computing, localized networks. What does 5G fit into this? 5G is being rolled out around the world, so everybody has access to super data. Now, anywhere that doesn't have 5G is getting Starlink and the other ones that, Elon Musk Starlink, right? So basically you're about to connect the entire planet with free data in the next 5 years. Everybody. You're then going to give them the whole crypto world of digital banking, digital money, stores of value, all of that. You're going to then be able to distribute computing power across massive networks, distributed computing like we do with cloud. That increases the computing power for science. And I mean, it goes on and on and on. We've got autonomous driving, autonomous cars. I mean, that's coming in the next 5 years. I think somebody between Tesla or Google is going to get that across the line. Sure, it'll be for Amazon delivery vehicles first or whatever. So we've got a ton of these technologies, and I've only listed some of them that are all coming out in the next 5 years. None of these are ideas now. They're all products. They're all happening. The Internet of Things. All of this is happening. So we're going to go probably through the largest change in human history of technology in the shortest period of time. And everything has network effects. None of these are new products. These are new ways of how we create productivity. We've also got the metaverse, the digital world. I think the metaverse itself can double the size of global GDP because it's like discovering the Americas again. It's a whole new world where you can earn money, own real estate, do investing, create businesses, live essentially. Okay, so you've doubled the size of the world. People don't get their heads around the size of what is happening. And, and crypto is part of that picture, and it's all happening right now. So I've now thought that the advantage the millennials have is they understand this. They're not cynical macro people who think the world is mean reverting. They kind of understand adoption effects. And if they can invest around it. This is why I wrote that tweet about Cathie Wood. People don't understand. She's got every one of these themes.
Oh my God.
She's got every one of these themes. And the old men railing at the internet are going, it's a bubble. They're illiquid stocks. I don't care. Cryptos are liquid. What you've got here is she's chosen pretty much every right theme that is going to be truly transformational, not in 20 years' time, not in 10 years' time, now for the next 5 years. So the probability of her hitting sure, some of these won't work, but her hitting a home run here is enormous. And nobody can see it because everybody's too cynical because they believe in a mean reverting world. And we don't live in a mean reverting world any longer. We live in the exponential age.
Yeah, I mean, and to some degree, those tech stocks were what have, carried everything along, dragged along the rest of the stock market on the way up during this entire correction. And they are arguably as good of inflation hedges as Bitcoin.
And yes, they are. Well, Bitcoin's outperformed them, but still, they're very good. They've outperformed the balance sheet and all of that. So the easiest way to head check, is this a network adoption style story or not, is just simply do a log chart. So as we do in crypto, right? We're so used to it, but we don't think of it in stock market terms because we're used to mean reverting. But if you just put a chart of Amazon on a log chart or Facebook, they're perfect. They're just perfect network adoption models. They're exactly the same as Bitcoin, exactly the same as Ethereum. They're all the same thing, which is they're just network models.
My question was, obviously, you generally see an inverse correlation. Dollar weakness, you see stocks go up, you see metals go up, you see all of this. Well, that was somewhat true with Bitcoin historically. But again, now that we've seen the dollar bouncing this time, we've seen Bitcoin raging next to it. What do you make of the fact that we're finally seeing, really both of them rising at the same time?
Again, we talked about the dollar is a very different beast and nobody really knows what drives it. It has what's known as a Bayesian distribution, which means that there's multi-factor kind of variables that affect it at various times. It could be current account deficits, it could be flows, it could be M&A, it could be interest rate differentials. So it's really hard to forecast currencies. In fact, the best forecasting of currencies is done by technical analysis because nobody knows how to model them. They're really complicated things. So there is times when crypto is correlated and times where it's not. Now, sure, if we have a massive risk off, let's say the dollar DXY goes to 105 in the next month, well, the chances are crypto is going to sell off because everyone's going to freak out.
Last March.
Is that a correlation? No. That's a passing correlation built on risk. There is a risk correlation between all assets because in the end, if you're going to liquidate some stuff, you're going to liquidate some stuff, whatever it is. So, but the overall correlation, that's the great thing, is Bitcoin is not correlated.
Oh my God, thank you. I had this conversation with Mark Yusko, and we were both sort of like screaming from the top of the hills. And just every time we mention it, somebody jumps in and shows you this very short-term correlation. They say, look at March 12th. Right. And don't understand that. No. Of course, there's going to be moments, but largely it's a random walk. And you can even, I mean, if you're a Markowitz fan or whatever, you can even dig in and say, listen, like mathematically, these are near a zero. They've never gotten to one. They're not correlated assets by any stretch, especially if you stretch the time frame. It just infuriates me, the correlation argument.
What they're all correlated to is something called a VAR shock. So that's the value at risk. When volatility climbs in your portfolio, you have to take less risk because if not, your risk of blowing up goes up. So what happens is people reduce risk. We've just seen that with the guy.
Oh my God. Arca something capital.
Yeah, whatever
obviously
the family
the huge
office
block,
was, right?
the huge block trading from Goldman
So
and
what
Morgan
happened with
last
him was
week.
that he had a VAR shock.
100 billion
himself.
bucks.
Yeah, he had a VAR shock himself, right? So he has to liquidate everything, and that created a VAR shock with other people as well. And so people just liquidate anything to pay the bills. And that happens periodically. That is not to do with the fact that the stock market went down. It's think of it as a separate thing. Is if risk blows up, then everything has a wobble for a period of time. And that's okay. And usually what happens is the things that are stronger, that have better stories behind them, better fundamentals, come out of that VAR shock much quicker.